Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good for the market at this point in time. Good time to get you the BTST call from our technical experts, Ashwani and Mitesh, with us for that. Excuse me. Ashwani, your thoughts first. Not looking good at all as far as the Nifty Junior is concerned. That's where we have seen quite a bit of decline. On the index, you said that you're carrying short positions. What about individual stocks?
So individual stocks, Federal Bank is a sell with a stop of 76, target of 70. RBL is a sell with a stop of 556, target of 535. And IGL is a buy with a stop of 258, target of 272.
Okay, it's lots of sell calls coming through. Mitesh, let's get your trades as well.
Yeah. I have BTST on Yes Bank with a stop at 370 for targets of 385, while Kaveri Seeds is a sell or STVT. Keep a stop above 546, look for targets of 525.
Okay, fair enough. Deepak Shinoy is back with us. Deepak, we were discussing that argument on PVR. Your thoughts?
Anuj, yes, PVR, I don't know, if I were them, this is a political problem right now more than an economic one. It's not like I see a lot of people walking in with bags of popcorn trying to beat the pricing of, PVR right there. Having said that, I think, PVR's valuations have been quite high. We're talking 50 plus as a PE, or I think now it must have corrected substantially. So there has been, a correction in the valuation. It's not come to a point where it's super attractive. However, we have to note over here that the problem that we're seeing is in 25% of their business. F&B had 75% margins, so you can obviously assume that this is a extremely high revenue and profit generating segment for them. If that is under threat, they will see some kind of problem in the margins forward. If you think longer term, however, I think PVR is the biggest multiplex or operator in the country. Fact that the country is still hungry for watching movies in theaters. It's more an experience, like you said, rather than just watching of a movie, because you can wait a few days, it'll appear on your pay-per-view or a Netflix or whatever it is. If people don't wait, they still go to theaters, they are going to continue to spend. And I don't think, while some of these pricing can change, I think PVR's strategy should be also political. They should perhaps call some of their multiplexes standard, where they reduce prices, and some of them premium, where they keep the higher prices. So if you're really, really desperate, you can go to a place where the prices are lower. If they were able to do that in a year or so, I think this will be behind them. I would like the valuations to correct more, because I used to be a buyer. I have gotten out of the stock more than a year and a half ago. So I'd like lower valuations to be able to buy. So I am biased in that context.
Sure. I'm personally speaking, I wouldn't mind lower popcorn prices either, not as a shareholder, just as a moviegoer. But Deepak, before we let you go, I just wanted your thoughts on another section of stocks that were making headlines for the wrong reasons today in the market. This shareholder allegation with respect to Kesoram Industries and Century Textiles, allegations of some insider trading with some Century Textile shares, 27.5 lakh shares actually. The stocks are actually down now, 4 to 5%. Volumes are slightly higher than usual on Kesoram as well. How would you view these companies from the Birla Group?
This is actually quite a serious allegation, Surabhi. I feel there is, management needs to address it. There has been a demand by BSE now to please explain, and we'll see what the explanatory statement comes out. The response by the CEO in the board meeting itself, or the AGM itself, was not very, great. They said this is not a related party that we have sold to, but obviously there are lots of common directors, their addresses are the same. This company called Camden and this company called Signet, which is a subsidiary of Kesoram, has apparently lost about 200-300 crores. Some of that is explainable, because if you sell Century Textiles shares in March 2016 and then buy it back in December 2017, the share itself has tripled. So if you did that, it was just a bad business decision perhaps. But when you did that, when the other side of your trade was a related party of some sort, whether directors are common or there are some people in that company who are actually office bearers in a subsidiary or in Kesoram itself, I think that casts a really bad sign on this company's corporate governance. Remember 3 years ago they sold division to JK Tyre, I think, and there was a very big consideration, 3,000 odd crores. And the worry is that is this a sign of siphoning away of that money which is supposed to be actually shareholder money? That's the fear. And I think we have to wait for management responses for this. But it is really, really serious, and I would not venture into this talk until we have this. And it's a very big group. This is Birla, and I think they should clear their name and give detailed responses to this. So I'm not buying, I wouldn't buy, I would not suggest anyone else to do so either.
Okay, all right, Deepak, we'll then wrap it up on that note. Thank you very much, as always, giving us your view on all the stocks that we've discussed and the market call itself. Speaking of clearing things, clearing, washing and the likes, it's going to be Spotlight on HUL in the next couple of minutes. We're expecting numbers to hit the screens anytime now over the next half hour. Mangalam is here to tell us what to expect. The bright spot, shall we say, hopefully in today's trade?
Hopefully in today's trade, the bright spot. So if the price is something to go by, for the last 3 quarters, HUL has been at a record high ahead of numbers. It has also been at a record valuation. And over the last 3-4 quarters, the street has expected a strong quarter. HUL has delivered that. So why? Because one, we have a favorable base. Q1 FY18 was the one where we saw a lot of destocking. So the volumes were down 0%, on the back of which we're expecting 11 to 12% volume growth to come by. And sequentially, the numbers will look good also because the momentum of demand coming in. We heard the managements of a lot of these FMCG companies. So key numbers to watch out for: 13.5% in terms of top line growth, close to around 9,700 crores is the number that you should be looking out for. 18.5% growth on the company's operational performance. 2,200 crore is the EBITDA that the street is working with. That means 100 basis points margin improvement around that 23% mark. And because of an 18.5% EBITDA growth and 13.5% revenue growth, the net profit expected to grow at 20%. But like in all the other FMCG companies, for HUL, the most important thing will be what the management has to say about improving demand outlook. Because remember, we have the low base right now, and on this low base, the companies are growing double-digit volumes. Going forward, this low base will then become an albatross.
Much has changed on the screen that we can report. Nifty Bank is down almost 1% as well. Mid-caps continue to be thrown around here and there. So that's the screen for you. So I guess the weakness seems to be persisting for now. Let's get you some more market opinion on that note. Earlier in the day, we caught up with Sukumar Raja of Franklin Templeton Investments, asked him about his view of the market and, of course, how he is looking at the volatility in the recent past.
We are not in the business of predicting where the market is going to go, but from our point of view, we see a lot of opportunities. There's been a lot of momentum in some sectors, and there's been lack of momentum in some sectors. As a value investor looking at long-term quality and sustainability characteristics, the universe of stocks which are looking attractive has increased from our point of view, and that makes it a very interesting market for our global and emerging market products to invest in.
Would you say that the Indian market generally is showing resistance at higher levels, is susceptible to is more susceptible to fall than rise?
I would think otherwise, because India is in a different part of the economic cycle. So we are still probably growing below trend, whereas most of the economies are growing above trend and have passed a peak. So I think there's going to be economic slowdown, and also potentially earnings are not going to be growing substantially in many of the other markets. Whereas in India, the structural factors continue to be very strong. And on top of it, because of all the problems that we have had in the last few years, I think the margins have still been depressed. While some sectors have shown very good earnings growth, there are a lot of other sectors where profitability is substantially depressed and can recover meaningfully. And even in the sectors that have done well, I think there is a continued scope for further earnings growth. So relative to other markets, I think India is still very well placed. And also from a demand for equities point of view, many markets might be more dependent on foreign flows, whereas the Indian market has a substantial support from the domestic flows. I think that's another important differentiating factor. So overall, I would think that India would be more robust than an average emerging market in the next few years.
What kind of realistic earnings growth can we expect over the next 2 years for the listed companies?
My view is that 2-year earnings are less predictable. They are subject to a lot of micro factors. Whether they play out or not, I think it's very difficult to say. But what I can say that the longer term earnings growth should be anywhere between 12 to 15%, and we have been growing below trend in the last few years. And as margins recover in some of the sectors, there's a good probability that we can grow above trend. But whether it's 20% or 18%, 15%, very difficult to pinpoint. But any double-digit growth should still support the broad market. And while the broad market might not give spectacular returns, I think by stock selection, we can still construct a portfolio that has very good risk-return characteristics, and that's our focus.
The basic point I want to understand is that because in 2017 we have had so much inflow into mutual funds, and we have seen a lot of retail would have perhaps entered at the top. In that sense, is there a bit of a risk to liquidity itself, the domestic liquidity, because foreigners have been selling, and a lot of domestic investors might now be seeing big losses in their portfolios?
There is always a possibility that a section of the investors have come because of momentum, but the evidence points that people are structurally allocating higher proportion of their savings to equities, and the equity allocation of the household savings is still in single digits and has scope to expand. And the money coming through the systematic investment plan has been increasing. So these trends point towards stability in terms of flows, while there is some possibility that some section of the investors might withdraw from the market. I wouldn't think that the net flows coming into the market over the next few years would decrease. In fact, I would think that if I take a 3 to 5 year view, the money that is coming into the equity market from domestic investors probably going to increase rather than decrease.
Well, a lot of stocks making fresh lows. United Spirits, just see the intraday chart on that one. That's made a fresh intraday low. Bharat Electronics, BEL, is at fresh intraday low. Dabur has made a fresh intraday low. So there are a lot of stocks where we have seen quite a bit of selling pressure right now. Excuse me. Mayuresh Joshi of Angel is with us. Mayuresh, hi, good afternoon. Thoughts first on United Spirits, down about 5.5%.
Afternoon, Anuj. After the aftermath of what the industry has gone through, the highway ban, demonetization, things seems to be coming back on normalization over the past few quarters. But what has also aided them, Anuj, is that the ENA prices, the extra neutral alcohol prices, have also remained subdued. So the kind of volume growth specifically in terms of the premium products for the industry as a whole, including United Spirits, I think largely played out in this favor. So I think the entire story of premiumizations, margins coming back to normal, and the worst in terms of the overhang, both in terms of demonetization, the highway ban, and regulatory overhangs probably behind them. But a large element in terms of what might happen going forward, specifically in terms of how this premium volume growth actually pans out in terms of competitive prices. And at the same time, I think the ability to probably hike prices, which is so very critical because key states like Karnataka, Tamil Nadu, Kerala, is something that probably drives a lot of this volume growth. The prestige and above products, which is a tad below the premium products, I think the volume sales for states like Andhra Pradesh and Telangana have been on the upswing. But I think it's premiumization which basically drives the margins and the earnings growth. So again, I think from a valuation perspective, I think the stocks had moved up significantly. They did correct in the past few weeks. But again, I think I'd be waiting out for further corrections and the forward multiples to probably correct even more before we probably take a call on the stock and the sector as a whole.
Okay, Mayuresh, good afternoon. Of course, the only thing that's working in the market today once again is technology. If you were to buy a tech stock fresh, which one would it be? If you could name one large cap for us and maybe one mid cap that you'd still go with.
Afternoon, Surabhi. No, so after the results of TCS, I think very, very encouraging signs in terms of BFSI actually coming back very sharply. Even if you see in Infosys's numbers, I think the TCV wins of $1 billion that they've done, 40% coming in through to the BFSI sector. So that's a major chunk that accounts for the sectoral contribution for a lot of these large cap IT names, barring aside except Tech Mahindra, which probably depends a lot on communications, and HCL Tech, which is a significant chunk of IMS and engineering services. Now the buyback that HCL Tech has announced and the expectations of what can actually come through in terms of the earnings profile, yes, I think it has lagged behind in terms of organic growth, but I think the inorganic acquisitions that it has done is clearly abetting its dollar revenue growth and the constant currency growth as well. Having said that, again, I think the IMS part, which is a big laggard for HCL Tech, that should bounce very smartly in our opinion in the second half. And again, I think the engineering R&D services division again should bounce back sharply in terms of both execution, and that should be a ground base laying fact for the margins probably to sustain and expand going forward. So again, the capital allocation policy, what we've probably seen in terms of what can get rewarded back to shareholders in terms of free cash flows getting distributed remains a common thread. But HCL Tech, in my opinion, on declines is something that we'll still continue to prefer. Within the mid-cap universe, our own sense is that nuclear software is something that we'll continue to like on significant declines. What the company has invested in terms of its platforms over the past few quarters should start paying dividends in terms of interest and cash flows actually improving over the next few years.
Okay, well, let's also get an insight into dealing room chatter. Then Nimesh Shah is here with Trader Talk. Nimesh, bloodbath right now in the broader market. What's been the feedback?
Oh yes, Anuj, clear bloodbath in the mid cap and small cap. Honestly, but there is no specific reason for such a fall in the mid cap and small cap. The volumes are on the higher side. That indicates that there is some bit of panic as well. And also, the sense I'm getting is maybe in some of the liquid non-index mid cap stocks, there is some bit of leverage pain as well. So it's a combination of a lot of things which is putting so much of pressure in the mid cap and small cap. I believe there is some bit of shift happening in the PMS side as well. So maybe there is some bit of selling coming in from the PMS side of investors as well, and there is lack of buying support from the domestic funds generally in the mid cap and small caps in today's trade. So that's been the key reason for this panic which is there across the mid cap and small cap space. Even in the large cap names, if you look at the pharma names post the DRL setback, most of the pharma stocks are under pressure today. Metal stocks are under pressure today. So there is no specific sector to hide in this today's fall. So looks like it's a one-way slide. Technically also, I'm getting a feedback that both the Nifty and the mid-cap index particular are looking weak and can fall further from here. So it's basically a lack of buying interest than large selling, which is coming from the larger institution, is what I understand is the reason for today's mid-cap and small-cap fall. But no specific reason can be attributed to this fall, but generally it looks like there is some bit of panic now. And maybe earnings season is going to set the tone for mid-cap and small-cap in general, because the general feedback that I'm getting is in an rising interest rate scenario, you will see a lot of pain in the mid-cap and small-cap. So big pain in mid-cap and small-cap. Clearly looks like there is panic now within larger institutions, but no specific reason for today's fall in mid-cap and small-cap.
Okay, all right, thanks Nimesh so much for that. Has changed. We are down over 460 points in the mid-cap index. That's your big headline. Nifty and Sensex have also been struggling. Mayuresh Joshi, Ashwani and Mitesh still with us. Ashwani, I mean, there's not much has changed since we actually began our conversation on closing bell today. So still looking at holding on to all the short positions?
I don't think there is great reason to cover. And let's understand that from 99.50 you ran up to 10,400. The same can happen this time as well. So all the pieces of the puzzle are there. You've come off strongly from 11,050, and now as we move on, probably more and more longs will cut their position, because this sort of selling happens when people who are expecting life beyond 11,050, they start to cut. And this mid cap carnage, why has it happened today? I mean, like the 600 points. Last year it was a cost of capital rally. Each time inflation gets bad, the mid caps, they fall because the cost of capital theory goes out of the window. So that people need to understand that there's nothing much to do with fundamentals here. Again, as a year, we'll stay between 10,000, 11,000, and possibly by the end of it, everything after chopping up everybody, the market may end up at 10,500. Now next moves, big moves will come with opinion polls. Till that time, we'll keep doing these 200-300 point ranges.
Okay, Ashwani, actually that was my next question. You've seen many market cycles. You know, this kind of dichotomy cannot exist for long, right? The Nifty doing well while mid caps, you know, keep collapsing. Advanced decline. We had a Sensex hitting new high while the advanced decline was at about 1:4 or 1:5. So I'm not talking about next week or 10 days from here. The bigger cycle. What are we looking at here then?
See, that's how distribution is done. If the Nifty would have fallen 500 points, you can't sell any mid caps. You'll get volume only when the market is, optically at 11,000. Long term, possibly next year will be another trending day. This is a sideways day after a big trending year last year. So that way, long term you are still on track. But mid caps will only go up when the rate cycle turns. If tomorrow inflation collapses, RBI becomes dovish, chances are mid cap rally will again pick up. So that's the nature of the beast. Looking at fundamentals in mid caps, I don't think is a very intelligent way of investing. I'm not talking about quality mid caps like Motherson, etc. But the moment you go below that, we've seen what happens with Manpasand and PC Jewelers. These were all 800,000 rupees stocks. So that is a problem you'll continue to have till the markets pick up again and till the rate cycle turns again.
Okay, gentlemen. Well, let's start closing out what's been a real Monday blues or Monday reds, rather. I guess, Anuj, we can say it's been a bad day, I guess.
Oh, really bad day. Just look at the intraday chart of a PVR. I think that is really tells you the kind of problem that the market has right now. If last year you would have seen this kind of decline being bought, to follow through 5% downtick is telling you that there's obviously something wrong here. Now in terms of index, we were down about 80 points, but that really wasn't the problem. The problem was in the broader market that Surabhi will talk about. In terms of index stocks, Dr. Reddy's was down 10%, and that led the entire pharma sector down. So Lupin was down 6%, Sun Pharma was down 4.5%. and a couple of others were also down. The pressure on the index came from Reliance, which was down 2%, ICICI Bank down 3.5%, Tata Motors down about 4%, and State Bank of India, which was down about 2.5%. You could add a Tata Steel as well, down 7%. Adani Ports down 3%, Bharti down 3%, though they don't have too much weight in the index right now. Even a strong stock like Bajaj Finserv saw some selling pressure today. On the way up, Infosys was interesting, though it has to be said that intraday it was up 5% at one point. So from that point it slipped as well, but it's going home with about 1.3% gain, and Tech Mahindra was the other gainer, up 2.5%. By the way, Lever is trying to end the day at the high point, which is quite interesting. Towards the end, there has been some buying in Hindustan Unilever, so that's also going to be an interesting stock that of course will track tomorrow morning.
Absolutely. We're coming to the mid-cap, so I don't know where to begin. It is such a deep sea of red. Starting off with, of course, the newsmaker of the morning, PC Jeweler, is finally going home with a cut of about 26% now that there's no buyback. We've had lots of selling on the MSO stocks once again. Den Networks down 16%. Hathway is lost in double digits as well. And then a long list of losers. Since we're talking media, let's just pull up the final rates on PVR, Inox, Mukta Arts. All of these stocks are down. PVR about 5.5%. Inox about 4% thereabouts. So the selling continued on this pack. In terms of stocks moving down on news, Ashok Leyland obviously stands out. That was the afternoon stock really. 5.5% down off the lows, but still deep cuts on this one. Shriram Transport Finance should come up for you as well. Again, there was a recovery from the lows on Shriram Transport Finance, yet there's a 3% cut that we're looking at. We've seen plenty of selling on the Birla Group twins as well, Century Textiles and Kesoram, on all those allegations that have been flying around. It's about 4%, 5% down on those stocks. So these are the newsmakers. DCB Bank, by the way, 11% down because of the fact that the market's not happy with the margin performance this time around, and of course slippages. Let me now move beyond. I mean, now I've pointed out news, let's go beyond the news. Then there's a long list. NCC down 10%, Reliance Capital 9%, JP Associates 9%, Jet Airways 8%, Gen Irrigation 7%, India Cement 7%, a stock like Tata Global 6%. I mean, it's such a deep day of losses. United Spirits 5.5%, 6%. IDFC Bank down about 5% as well. Tata Motors DBR, by the way, Tata Motors also incremental negative thanks to the loading news. Even the DBRs ended about 5% on the lower side. There's really nothing to speak of on the gainers, barring some of the mid-cap IT names. Let's pull up Mindtree, 1.5% up. We have seen some buying on a First Source, for instance, and the gas stocks. That will come up for you. IGL about 4% on the upside. But barring a couple of these odd names here and there, there isn't much to speak of on the gainers list today. L&T Technology Services, again, tech, largely it was tech and some stocks on the gas side. But beyond that, there's nothing really to talk of on the mid-cap side of the screen, Anuj. That's been the extent of the fall today.
Again, the issue here is today the start of the next round of mid-cap decline, where even the good quality stocks are being targeted. We saw the panic selling in the month of June, and we refer to the near-term panic being over. Is it start of now fresh unwinding? We'll find out. But the more you look at the screen, today's delivery numbers will be interesting in a lot of stocks. Pharma, for example, was one sector which was holding out. Today, the way these stocks have fallen is giving an indication that perhaps that one leg for the market may have been gone. So overall, not a good day, whichever way you look at it right now.
Okay, fair enough. Well, on that note, let's just take a final comment from our experts. Mahesh, not really a market where too many people are going to venture out to buy mid-caps. There's sort of a lot of unease out there with respect to quality, liquidity, growth, etc. But if you do have a pick, just leave that with us in 30 seconds and, of course, the caveats that might apply.
So yes, being very selective is obviously very important and pertinent. So Bata India is something that I'll continue to prefer in a staggered way. The entire premiumization concept in terms of 40% of their sales coming through premium products is expected to increase. 30% of its sales coming from ladies footwear. So that is expected to increase significantly. So they are high margin products which will probably abet their margin expansion to around 14.5%. It's already a cash rich balance sheet. 588 crores on its balance sheet at this point of time, and they've capped their rental expenses. So what they're expected to open 500 odd stores over the next 3 to 4 years, 435 cities identified, but the rent as a percentage of sales has been capped at 13.5%. So to that bit, I think the earnings growth should be stupendous. ROC is at 19.8, expected to improve 200-300 basis points over the next 2 years. And I expect the company to report a 16% top line, 24% bottom line growth, giving and lending support to the earnings trajectory that I was talking about. So any decline in a staggered way, long-term investors can have a look at this consumption-driven stock.
Okay, Bata India is the pick then. Mitesh, final thoughts, advice for tomorrow, given how this week has started off?
I think, we closed below 10,950 and that is slightly negative to me too. So I think we might actually dip down a bit more, 70-80 points. The bank nifty slightly looks on the weaker side along with the metal index. So I think these two could be the pressure points. While IT still looks more of a stable index, or even the stock structures are slightly better placed to trade on the long side. So I think we'll continue with that trade of shorting financials and metals vis-a-vis, I think trying to explore some long positions in the IT side. The only financial stock which I like possibly right now is Yes Bank. I think anything close to about 370, 375 would be excellent entry point.
Okay, gentlemen, thanks very much. Thank you for taking us through some stories before we get those HUL numbers. Vedanta-owned Sterlite Copper has been in the news for quite a while now. The Supreme Court has asked the company to pay a fine of 100 crore rupees for violation of environmental laws. In an exclusive conversation with our colleague Jude Saneth, the CEO of the company, P. Ramanath, talks about the loss incurred by the plant's closure.
The Supreme Court has very clearly said that there may have been some deviations as per the Neary report, but these deviations are not so serious that they cannot be rectified. Supreme Court also said that our plant has operated for a certain period of time without a consent to operate, and that I can tell you is not because of our issue. We have been applying to the consent for the renewal of the consent to operate every year and paid the fees to the extent of 15 to 20 lakhs or whatever is the fees that TNPCB charges. But TNPCB because of their own procedural constraints or whatever, they had not renewed it for a period of time. So I would say that for the fault of TNPCB for not renewing it, for not doing their procedural aspect properly, we have been fined the 100, or rather I would say that we've been asked to deposit 100 crores to take care of any kind of environmental matters that needed to be done in the region. Now thereafter, this 100 crores has been deposited in 2013 with the collector, And this has, since then, it is the interest is roughly around 40 crores. Out of this 40 crores, only 4 crores have been spent on roads and not on any kind of environmental aspect. So are we to assume that there was nothing wrong in the environment because of which the TNPC did not find any reason at all to spend the 40 crores?
Two very important concerns continue to exist, though. The first, of course, is the fact that, and this was pointed out by the Madurai bench of the Madras High Court as well, that you got the NGT clearance and the environmental clearance from the Ministry of Environment, rather, without having a public hearing. Your defense was that considering it's located within, an already assigned industrial complex, a public hearing wouldn't be necessary. But what's important to point out is also the fact that the industrial complex did not exist. It was a proposed expansion for your proposed...
Okay.